This is Jill McSpadden. I've known Jill now for about 2 years. We met through the Tampa Chamber. Her CPA firm actually just recently won the Tampa Chamber Small Business of the Year award. So yes, not only is Jill an excellent young professional, an excellent CPA, but she works for an excellent firm as well. We're excited to have her talk to us today about taxes, business planning, specifically for real estate agents. It's one of the topics I know is pretty popular. As real estate agents, we're our own business owner. And so part of that is understanding your profit and loss statement, your expenses, and filing your taxes. So I know you're going to touch a little bit on that. So Jill, go ahead, take it away.
Yeah, great. All right, let me just grab this. So, yeah, my name's Jill. I went to the University of Florida. Go Gators. So, I'm excited to be here. Let's see if I can. There we go. Okay, so I thought I would start out with probably the biggest difference between a normal employee and real estate agents is that you no longer are a W-2 salary, so you need to be making estimated tax payments throughout the year. And if you owe more than $1,000, you may be subject to estimated tax penalties. So you want to avoid that. Quarterly payments are due on 4/15, 6/15, 9/15, and that should be 1/15/2019. So for this year, really, if you're looking at for 2018, you should be looking at making a payment by this January 2019. So this is probably a good time for you to be thinking about how your year's been going and kind of use this last quarter to assess, and then think about making a payment by January 15th. So you make your estimated payments using Form 1040 ES. You can get that online, and you can make your payments by check or on the IRS website. There's plenty of different ways to make your payment that make it nice and easy. So how much you have to pay is kind of hard just for me to say. I was trying to think of ways that I could, explain it. It really depends on your individual situation, and if this is your first year, if you're used to being a W-2 employee and this is your first year, it might be kind of hard to look at last year and use next year for planning. So the best thing you can do is looking at your effective tax rate from last year and kind of gauging that based on your income for this year, and then seeing what you can do with that. So a big difference from being a salary versus working on your own is you're subject to self-employment tax, and that's in addition to your federal income tax. So if you think about it, when you get a paycheck, you get Social Security and Medicare withheld from your paycheck. You have to pay that on your own now that you are self-employed. So, and you have to pay both your portion and the employer portion. So that's why it's 15%. So this is on just your business income. So just your real estate income. If you have other income, that's not subject to this tax. So when I was saying it's kind of hard to, just tell you a flat rate to withhold from your commissions, you do want to keep in mind that your commissions will be subject to this rate in addition to federal income tax. So let's see. So next I thought I would move on to common business expenses that I thought, a lot of real estate agents would want to be aware of and keep in mind. Auto and transportation, you guys are driving all over the place, so you want to keep track of that. Business travel, not so much. I don't know if you're going out of town so much, so that might not apply so much. But business meals, if you're meeting with clients, those 50% of that is deductible. So, I mean, no.
I heard they want the itemizer state delivery. No.
I mean,
my suitcase.
What? No.
He's like, I was like, it's a liquid bag.
I'll get into a little bit more details, but I'll double check on that. But we don't, screen through. I don't have time for that. So itemize. So you do want to make sure it is a business meeting, though. You can't be calling, just going out with your friends, necessarily a business meeting. So this is you're actively engaging with a client, a potential client. So I'll get a little bit more into business meals because there is a little bit more details to come. Advertising and marketing, huge for you guys, I'm sure. Real estate license and renewal fees, you probably are on the hook for that. I doubt you don't have an employer paying for that, so you want to make sure that's deductible. Office supplies, probably not a lot, but you might have some here and there. Gifts for clients, there's a $25 limit, so, and telephone. So, okay.
Is that including cell phone as well? Landline and cell phone?
Yeah. So, tips for keeping track, probably just whatever, just have a system, I think is most important. It depends on the volume that you have. I would say it helps to keep it all, in one place with like a business credit card or a business bank account. But, depending on the volume, it really depends on how sophisticated you really want to get. So a spreadsheet is just fine. Apps, there's tons of apps out there that can help you, that can hook up to your credit card and help you keep track of these. And for the most sophisticated, there are some bookkeeping software like QuickBooks Online, SelfEmployment, and they work the same way as the apps. It tracks your credit card transactions, and then you can exclude personal and then help categorize your business expenses. So, but I think most important is just to have a system and stay as organized as possible. Most CPAs charge by the hour, so if you just bring in a big box of receipts, your CPA is not going to be real happy, and they're going to charge you for that time that you could save just doing it yourself. And really, you kind of need to do it yourself because only you know what this stuff is. So, and you want to be saving, your receipts just in case you get audited. So, okay. So this is back to meals and entertainment. You technically need to be keeping track of your records in case you might get audited. I like to think of it as who, what, where, when, and why. So who was there? Why? What's the purpose of this meeting? What's the business purpose? Time, date, location. Your receipt will have the amount. So a lot of times you just take the receipt right on the back of it or something, or take a picture of the receipt, and there are some apps that you can capture this information really easily. And then that way you don't have to worry. So, but for your business meals and entertainment, you should be keeping a log of this. Otherwise, the IRS could come in and disallow your deductions. So,
is that phasing out meals?
So meals are 50% deductible. Entertainment are no longer. So you used to be able to, like lightning games, or those are no longer deductible, but business meals still are 50% deductible. Yeah. And social club memberships are not deductible. So if it is a business kind of membership, like a chamber of commerce, that is. But if there are some social, like crew maybe, or so, probably not. Yeah, definitely. Or gym memberships, not deductible. So it has to be pretty clear, like a chamber of commerce, a business association, or you're not lawyer, but a bar association. So, and then business meals cannot be lavish. It's kind of gray what is lavish, what's not, but I think most of us are, care about our bottom line enough that this isn't usually an issue that we're going off and, spending a bunch of money on client meals. So as long as it's, reasonable, it shouldn't be a problem. So
if we're hosting a client appreciation event or something like that, or a first-time homebuyer seminar, having it here or buying food and drinks and things like that, is that meals or is that entertainment?
That is neither. I mean, that's just client development, advertising. Yeah. So, did you have a question?
No,
okay. Christmas parties are still deductible, or they always use picnics. If you want to take your employees out, on a picnic, that's still deductible. So it's really the entertainment that's the biggest change in that for next year. So. See. Okay, so a little bit more on the auto expenses. These are your car loan interest, the title or tax on your car is deductible, parking fees and tolls, and then there's two different methods that you can keep track. There's a standard mileage rate. In 2018, it's 54.5 cents per mile. And you do need to keep a log similar to the business meals substantiation, kind of where you're going, why you're going, business purpose. And I've seen some really cool apps that can help you keep track of your mileage, or a lot of times we'll tell people just take a picture of your mileage, your odometer, at the beginning and the ending of the year. That's kind of a nice tip. And that way you can kind of do some math and kind of back into what your mileage was. I mean, you can use reasonable estimates. So, but look, taking the picture of your odometer is kind of a nice tip. Or you can just use actual costs. If some people don't want to worry about the mileage and they just want to keep it all on their credit card and just deduct it directly. So you can't do both. You got to pick one or the other. IRS doesn't let you double tip. Okay. So and you got to prorate between business and personal. So again, you either using mileage or just reasonable, the mileage of your commute, so you can pretty reasonably figure this kind of stuff out. So, okay. Let's see. Okay, home office. The two requirements are it needs to be regular and exclusive. So that I feel like is the toughest one because a lot of people don't necessarily use it exclusively for business. But if you have an area, it doesn't even need to be like, a wall or a door. It could just be a little nook that you have. But if it's regular and exclusive use and the principal place of your business, you can deduct expenses relating to your home office. So you want to kind of measure out the square foot of that area over the total area of your house, and then you can all of your home expenses, rent, mortgage interest, insurance, utilities, repairs, even depreciation, and using that fraction based on your home office, you can deduct those expenses. Or there's a simplified method, it's just $5 per square foot of the area that you use. So, which I don't feel like it's really that much. So, but that is available. And hopefully this isn't a problem, but you can't take a deduction larger than your income for your business. So hopefully you're making plenty of money, so that's not an issue. Okay, so self-employed health insurance is deductible. It's a little different than your other expenses because it's actually taken on the front page of your 1040. And it's your medical, dental, and long-term care insurance for self, spouse, and dependents. It's also limited to your business income. And you can't take both that and on as an itemized deduction. It's just you can't double dip. The IRS always just doesn't let me double dip on deductions. And it does not reduce your self-employment income. So that's why it is different it's not reported on your Schedule C. It is reported directly on your 1040. So, okay. So this is a brand new deduction in 2018, and this is kind of had all the CPAs scrambling to figure out what it is, but it's called the Qualified Business Income Deduction. And it is just straight 20% off of your qualified business income. So that would be your real estate income. You can take 20%. So I don't know how closely you follow, politics or, the new tax bill that came out reduced the corporate income tax rate to 21%, I believe. And this deduction, so the problem is most small business taxpayers don't have C Corps, they have pass-through entities. So this is a way to even the playing field. So this, and it's very complicated, but the simplest way to explain it is it's just a 20% deduction of your business income, and it's taken on the second page of your 1040. I believe it's right below your itemized deductions, so it reduces your taxable income. Good news for real estate agents, you are not subject to the specified service limitations. I'm not going to go into even what that is, but for certain business types of business, you have phase outs, but good news is you guys aren't subject to those. There is a W-2 wage limitation when your income level hits $315,000 for married filing joint, or $157,000. So, and that just means you need to have W-2 wages, or your deduction will be limited. So I don't know if any of you have employees, so probably not, yeah. So, but the good news is up to $315,000, you don't have to, there's no limitation. Any questions on this one? This one's brand new, so. Okay. Then I would go over other 2018 changes quickly, because this isn't really specific to real estate agents, but the standard deduction is increased. No personal exemptions. The child tax credit has increased. Okay. So you used to be able to deduct unreimbursed business expenses on your Schedule A. That went away. So those are all those itemized deductions subject to the 2% floor. That doesn't apply to you necessarily because you're going to take that directly against your business income on your Schedule C. So these are only on the Schedule A, your itemized deductions. There's no overall limitation anymore on itemized deductions. They reduced the medical expense deduction floor to 7.5% of AGI. Mortgage interest is now limited to $750,000 of acquisition indebtedness. It used to be $1 million. So for people who buy more expensive houses, their itemized deduction or their mortgage interest deductions can be limited. State and local income tax limited to $10,000. That affects your South Tampa property owners big time, I think. And the charitable contribution limitation was increased. And then no deduction for alimony payments anymore. So,
Your tax.
yeah, it could be interesting how that might change a lot.
That's going to change a lot.
Divorces, yeah.
I'm like,
Oh yeah.
Oh yeah.
Okay.
So that'll be fun.
I've read that people are scrambling because it does. You have till the end of this calendar year to get it done, and people are scrambling to get their divorces finalized.
And on the loan side, you either are married or not, and you're separated. Have the legal documents with the court stating you're separated. If you're not, sorry, but your husband's gonna have to.
Right. Yeah. So. Okay, so the rest of this is more general tax tips, not necessarily, just for real estate agents, but I am a big fan of the health savings account. It's kind of like a savings account that you can keep for medical expenses, and you can set it aside pre-tax, so you get a deduction when you just contribute it. It's just like a bank account. Any that you don't use rolls forward to the next year, so it's just kind of like a little health savings account that you get a tax deduction for, and then you can even invest that money and let it grow. It'll grow tax-free, and then any distributions are tax-free as long as they're used for health expenses. So it's $34.50 for individuals and $6,900 for family in 2018. You can make it make the contribution by April 15th of 2019.
That's your cap contribution.
Sorry.
That's your cap contribution annually. Yeah, $34.50.
Yes. Yeah. Yes. So and next I was going to talk about IRAs. So it's very similar to an IRA. You can contribute $5,500 for 2018, $6,500 if you're over 50, and make it by April 15th. So a traditional IRA, you can take the deduction in the current year, and then the proceeds will be taxable when you get your distributions. A Roth IRA, you don't get a deduction today, but then your proceeds are tax-free. So it's just it's a little bit of, it depends on your personal situation whether you want to take the deduction now, up front, or later. So, and yeah, that's it. So, any questions?
So, as we as real estate licensees, we can choose to have our license in LLC or to keep it in our own individual names. I could essentially set up Nico Homan LLC, and that becomes my company, or I could just be Nico Homan, a regular licensee. Do you see one way or the other as better, or what would you recommend as far as setting up a separate LLC for a licensee? Okay.
So for tax purposes, it doesn't make any difference. The only reason you want to set up an LLC is for liability protection. So that's a lawyer question. And however as your business, you want to set it up. But as far as tax purposes, an LLC is disregarded, so it makes absolutely no difference.
What about a C Corp?
A C Corp, that is totally different, but that is, that's its own entity that will be taxed on its own and have its own taxable income. So.
And you, as Alyssa, can't be a C Corp real estate agent. Yeah, if you were a broker and wanted to open up your own brokerage, that could be a C Corp. But you, as an individual licensee, you can only be a PA or an LLC.
And especially for smaller taxpayers, you want to consider the transaction costs. It's a whole nother tax return. Subject to tax on its own, and then any money that you take out is going to be taxed as a dividend to you. So there are situations where a C Corp does make sense, but I think for smaller taxpayers, you just want to go with an LLC or just on your own on a Schedule C. So.
But as far as deductions, software, technology, things like that, what is and isn't considered business expense?
As far what kind of
so
software?
Like if we have contract management software, or if we have a piece of cell phone software, like what are those considered deductions?
If they're related to your business, yeah.
Yeah.
Yeah. Any business expense is deductible. Yeah.
What about personal dry cleaning or work?
We get that question a lot too.
Yeah.
Only if it is a uniform that can't be worn anywhere else. So if what I always kind of use is if you have overall bibs or something, but for real estate agents, you're wearing normal clothes, so it doesn't really work that way. So that's personal, unfortunately. Yeah.
What are some of the biggest mistakes that you see real estate agents make when it comes to filing their taxes or preparing their income statements?
Not being organized. Like I said, I mean, you're really hurting yourself by waiting to the last minute and bringing the shoebox of receipts. It's just going to cost your CPA a lot more, and it's not going to be very helpful. Waiting to the last minute with estimated payments, you just want to stay on top of that, or really more commonly realizing you have a big tax bill and you haven't been saving your money. So hopefully you all are setting aside money as you get your commissions like you would. I mean, you just have to think about how a W-2, if you were a W-2, that money would be withheld from your paycheck. You need to be doing that yourself. So that's the biggest mistake I see is they get this big commission check and then go spend it, and then, well, sorry, you got to pay tax on it. So.
Anything else?